Hi, my name is Alexandra Simion, and in this video I will analyze the Johnson & Johnson company to see whether it's a good or bad investment using Hult lens for information. Johnson & Johnson is an American manufacturer and seller of a vast variety of healthcare products. Its product range is spread across three main segments: consumer, medical devices, and pharmaceutical, with the latter bringing in almost half of the company's revenue. Geographically, the most profitable markets are Europe and the US, together amounting up to 72% of sales revenue. The recent performance of the company's stock price displays a strong upward trend. Also, economic profitability is at a historic high, having exceeded pre-economic crisis levels. The relative wealth chart shows that management has succeeded in creating wealth since CFROI levels have constantly been well above the discount rate. The declining CFROI forecast can be attributed to fade, but low historic CFROI volatility, large market cap, slow asset growth, and exceptional credit ratings indicate that the fade effect will occur very gradually and in a fairly linear manner. Asset growth is also not too volatile due to periodic acquisitions undertaken by the company. Out of these, the most notable ones in recent years were the Pfizer consumer business at the end of 2006 and Synthes Inc. in 2011. Reduced growth years are also present, stabilizing CFROI levels. It is expected that the company will consider performing a new acquisition in the near future since it owns large amounts of cash reserves. The stock has consistently outperformed the S&P 500 index, particularly during the economic crisis, and has guaranteed reliable returns to investors. Amongst the drivers of CFROI, what stands out is that operating margins have reached historic highs, while asset turns are nearing a historic low. The effects of these factors cancel each other out, so over the past 10 years, CFROI has been strongly correlated to the sales figure. If nothing changes, this trend will continue in the future, but with a slow and linear sales growth forecast, management should try to deploy the company's assets more efficiently in order to boost CFROI. Compared to its peers, Johnson & Johnson is ranked only slightly above average on the Hult scorecard. However, its valuation ranking deems the stock very attractive to potential investors at its current price. While a median PE ratio might not attract much attention, the slightly lower price-to-book ratio indicates that the stock might be undervalued, while the dividend yield ratio is amongst the best in the industry. To conclude, the Johnson & Johnson company stock is a safe blue-chip addition to any investor's portfolio. The warranted price is above the market price, showing that the company is undervalued, so investors should take a long position. Due to the many sources of competitive advantage and a history of value creation, Johnson & Johnson will continue to outperform the market and generate returns for stockholders.